Good morning and good afternoon. I'm Todd Rosenbluth. I'm the head of ETF and mutual fund research at CFRA. Thanks for joining us for understanding how and why to consider thematic ETFs. We're big believers at CFRA on what's inside matters. I'm joined for this webinar by some colleagues from Global X, Jay Jacobs, who's the head of research and strategy, and John Mayer, who is the chief investment officer at Global X. We're going to walk through a number of different topics about thematic ETFs and specifically how you can make use of them as we talk on individual topics. We'll move to the next slide here, just a reminder about CFRA, who we are and our history. We've been around for decades, both as the group that was CFRA and then the group that CFRA acquired from S&P Global, which is the equity and fund research business more than 3 years ago. We've expanded our ETF presence, as you can see in 2019, acquiring First Bridge Data to provide raw data and analysis. We're going to cover some of that. And today, we're one of the largest independent research companies covering stocks, ETFs, and mutual funds. You'll see on the next slide how we are laid out and the various fundamental and accounting research techniques we're using. We offer commentary on sectors, industries, and the markets. We focus on ETFs and mutual funds, which we're going to spend some time on here. But what's behind that is coverage of individual stocks, both qualitatively and quantitatively, using both fundamental research as well as forensic accounting and legal and exception-based insights. A lot of research that drives our overall ratings and recommendations. You'll see on the next slide here, we are an independent research provider. That's all we do is research. We don't have an asset management arm. When we're offering a recommendation, as we will on some of the ETFs later on, it's because this is what we truly think. There is no relationship that needs to be disclosed in terms of we are the index provider behind this, we are the asset manager behind this. All we do is research, which, as you'll see on the next slide, allows us to go deep into covering ETFs and mutual funds. We believe we have a more forward-looking approach than others within the industry. We do that leveraging that forensic and fundamental accounting methodologies that we talked about earlier. A team of 75 analysts is behind the scenes picking the individual stocks and assessing the valuation and risk considerations of these companies. And we're combining that with more other metrics that are fund specific. We'll see on the next slide here about how we go about doing that to drive an overall rating of ETFs from a cost, reward, and risk perspective. The cost is as simple as the expense ratio and the price to net asset value. From a reward and risk perspective, we are also looking at metrics tied to the performance record of the ETF, both in short and intermediate time periods. We separately rate mutual funds. We won't spend much, if any, time during this webinar, but we recently upgraded our mutual fund ratings this month, and the ETFs we're talking about today are being compared to just ETFs. Mutual funds we think are a different animal, and we separately are assessing those. So let's move to the next slide here to just jump further into the presentation. And this is where I want to bring Jay Jacobs in from Global X, who's the head of research. Jay, we'll move to the next slide here, but I think it'd be helpful for you to talk through how Global X thinks about thematic investing and what differentiates it from perhaps a more core approach.
Sure, thanks Todd, and thank you everyone for joining us this afternoon. Great to be on the webinar. Thematic investing is something that's very core to Global X. It's something we've been doing for 10 years, starting back in 2010 with the launch of our lithium and battery tech ETF. So we've put a lot of thought into, first of all, what is thematic investing, and how do we identify the themes that we would bring out in an ETF? So definition matters. First of all, we define thematic investing as the process of identifying powerful macro level trends that are disrupting huge swaths of the global economy. And then from the bottom up, looking at which companies really stand to benefit from the materialization of those trends. So if you look around the world and you look around the investment universe, you see a lot of themes being suggested by a lot of different investors and thought leaders. We actually did the work to kind of aggregate all of those themes and to put them in what we call the thematic universe. And there's between 60 and 70 of those themes that people are suggesting are out there. Everything from robotics and artificial intelligence and cloud computing that we'll talk about later today, to maybe more kind of out there themes in areas like blockchain or sports betting or things in that space. So what's important for us is to really kind of hone in on the themes that we think make the most sense from an investor perspective. And this is where our 3 criteria come in that you see here. The first thing is, do we have high conviction behind that theme? Do we believe that it's going to disrupt a huge part of the global economy? To get to that conviction, we look at things like, what's the total addressable market? How much of that market has already been addressed? What are expected growth rates? If it's a technology related theme, is the technology viable today? What industries are going to be impacted by this? Is it disrupting existing industries or creating entirely new ones? This is where we do a lot of research to really understand the theme and its potential for disruption. The second thing we look at is investability. Investability is looking at how many publicly traded companies are there that we could get exposure to. So ETFs have to invest in publicly traded companies. They have to have more than 20 companies. Our preference is really to have 25 to 30 companies, if not more, to have a little bit more diversification. But more importantly, we want those companies to be really heavily targeted at that theme. We don't want it to just be kind of a more tangential exposure or a minority of that company's revenue. We really want it to make up the majority of that company's either revenue or R&D or assets. And frankly, that's where a lot of themes fail, is that, they're an interesting concept, but they're just too early. They very much exist in the venture capital space or the private equity space. They just don't really exist in the public market space. And the third thing we look at is time frame. We want themes that are going to be, really long-term in nature, multiple decades, if not even evergreen in nature. The longer term that theme is, the less important it is to think about entry and exit points in that theme, because it's really investing for the long term. If it's a short-term theme, think about all the people talking about trade wars last year. Timing that is everything. That's the only way to make money in that theme. But if you're looking at something like robotics, it has much less to do with the precise timing and much more about identifying the companies that stand to benefit from the materialization of that theme. Next slide. So another key differentiator in thematic investing is the difference between structural themes and cyclical themes. I hinted at this a little bit before. Structural themes are those that tend to exhibit themselves over the long term, and they're not mean reverting. If you look at a new technology tends to only improve. Demographics tend to be very one directional in terms of an aging population or the rise of a new generation. These structural themes are very powerful and take that S-shaped curve where they go from one point and over time move to another point on that curve. That is a sharp contrast to cyclical themes, which follow that blue wave pattern. They come and go at more frequent intervals. And because of that wave pattern, it's all about the timing. So, sometimes you hear in the news playing the theme of volatility or the theme of growth over value or the theme of a depreciating yen. If you take a broad definition of thematic investing, you could include those, but it's important to at least recognize that those are cyclical themes that are going to be much shorter term in nature and do not have that one-off shift that can be captured through long-term investing. Next slide. And that S-shaped pattern does have backing in academia. Everett Rogers introduced the diffusion of innovation theory a few decades ago, and it was really all about this concept that early on you have slow adoption of a theme. You have the innovators who look at a new technology or look at a new idea and really take a risk on adopting it. Think about the people that bought Google Glass. It's a technology that frankly didn't work out. It was very early on. It was very innovative. Maybe didn't work that well. Maybe it was pretty expensive, didn't have scale. But that's the risk you take as an innovator until it starts to really penetrate further and you see early adopters and the early majority start to adopt that theme. More of the general population is coming on board with that technology. Maybe that's the number of people buying smartwatches today or 4K televisions or even electric vehicles is starting to enter that early adopters phase. Until finally the vast majority of the population has adopted that technology and it enters into the later stages, the late majority or the laggards, where growth actually starts to slow down because it's fully penetrated that addressable market. Think about where social media is today. 84% of US adults have a social media account. You see Todd on his social media account a lot, and John and myself. So there's not a lot of people left over who need to set up a social media account and join. So that's when you start to see the growth taper off. And if you go to the next slide, you'll see that this is actually a trajectory that many technologies have followed over the last 100 years or so. You can look at the telephone, electricity, the refrigerator, color TV, computer. They all follow some form of this S-shaped curve of slow initial adoption with a rapid increase in the middle and then slowly tapering off as the vast majority of the population now has this new technology or this new product. The one thing that I would mention is the difference between the newer themes like the internet and cell phones and computers versus the older themes is the steepness of that S-curve. These new technologies are being adopted faster than before. They are not taking decades. They are taking years, if not maybe even months. So that is certainly an area that we're keeping a very close eye on.
So Jay, thanks for that. We'll move here. Yeah, we'll pause here for a second. I think this slide that you're bringing up really paints a great picture about the overall landscape. I think people are hearing a lot about thematic ETF investing. It often sounds like a very crowded space, but there's actually, as you show here, just 125 products, including the net addition during the first quarter. Could you just talk through how Global X pulled together the landscape and what are some of the trends we're seeing?
Yeah, so this is taking thematic investing from concept to really looking at the ETF thematic space, the number of launches we've seen over the last few years and the assets tracking those ETFs. First I would point out thematic investing is not new. This is something that's been going on for multiple decades, but previously it had really been limited more towards either individual stock picking for retail investors. Think about buying Tesla because you want exposure to electric vehicles, or to very sophisticated institutions that had global exposure to baskets of companies that that are leading in a new theme. The advent of ETFs is what makes it so efficient to access these themes in a single trade. So as we've seen the rise in thematic as we've seen thematic investing grow in prevalence, we've seen kind of a corresponding rise in the number of ETFs tracking those themes. So if we go back to 2015, you had just about 40 ETFs with about 5 billion in assets under management. The number of ETFs has now multiplied by about 3x to over 120 thematic ETFs. And the number of assets, or the amount of assets tracking those funds, have gone from about 5 billion to 25 billion, about a 5x growth. So large increase in interest in thematic investing. A lot of those assets are focused on disruptive technologies, robotics and AI, cloud computing, cybersecurity, Internet of Things. That's making up the bulk of the assets today. But we still see a pretty growing interest in people and demographics related themes. These are themes that are based off of changing consumer habits and behaviors. Think about aging populations or rising millennials. And physical environment is growing as well. That can be renewable energy or infrastructure or resource scarcity. So we are seeing growth across all three of these categories as thematic investing makes more headway in the ETF space.
So we're showing here on the slide here just some of the themes in particular that saw growth during the fourth quarter, from the fourth quarter to the first quarter, and in many cases there were outflows. But we can see here on the slide, video games, emerging markets, internet. We wrote recently about the 5G and Internet of Things and how we saw growth during the first quarter there. So there's a lot of different choices, but we'll also see that it's concentrated in a few different of those mega themes that are touched on by Global X. Jay, anything you want to add to this before we move forward?
Yeah, one thing to point out is, I think it's maybe somewhat a sign of the times that cloud computing has now become the largest theme by assets under management. Previously, AI and automation had held that crown for a couple of years. But as we see more people working from home, streaming video and whatnot, the dependence on the cloud has really grown, and frankly, I think that's increased a lot of interest in the cloud computing theme, which has allowed it to leapfrog two other themes there to become the largest in the U.S. ETF industry. So we'll be talking about cloud computing and AI more, but I do think it's very, very interesting to see how the assets are following changes in the global landscape today.
I would certainly agree, and we'll move ourselves forward to the next slide here, and I'll just set up the next part of the conversation about what themes are relevant. We're going to get to AI and robotics and cloud computing in a moment, but I want to bring John Mayer, who's the CIO of Global X, in as we move to the next slide, just to talk about the macroeconomic environment, what we're seeing, how it impacts with COVID. So John, please join us. John, you might be on mute as we are showing the slide on it begins and ends with COVID-19.
Yep. Shoot. It's not doing. Can you hear me?
We can, John.
Cool, thank you. Thanks, Jay and Todd. I'm going to give you a little bit of an overview of what's going on right now from our perspective and to how this feeds into thematic investing. So as we all know, that our lives have been upended recently, and effectively the global economy has shut down as we look to flatten the curve with respect to COVID-19. And this obviously has caused a lot of disruption. And I think it all begins and ends with respect to the shape of the curve in terms of the cases and how we bring down that curve. Now, it appears that the spread of the COVID-19 virus has been slowing. Now, first, if you look to Europe, the daily growth rate reported in cases has fallen to about 5% in the US, and in Europe, it's about 2% in Italy, and Spain and Germany are fading to new lows of about 2%. So that was down from about 20% a month ago. So we have made some progress through the efforts of social distancing. Germany is the second country in Europe to see a decline in the number of active cases. And when I say active cases, that's the reported cases minus those who have died or recovered. Now, the number has fallen to about 60,000, down from 70,000 a week ago. That has taken some pressure off hospitals in Germany. Now, despite the improvements in Germany, the COVID-19 statistics, the government in Germany seems poised to extend the lockdown to May 3rd. And there are other countries in Europe, like Austria, Denmark, and even Italy and Spain, that are relaxing some of the containment measures. Now, the US caseload has leveled off some, and we are seeing some flattening in the curve, but the numbers of cases and deaths are still pretty high. The epicenter of the cases have been in the New York area. Governor Cuomo in New York has stated that the worst is over, but the efforts of social distancing really needs to continue. And 6 governors around the tri-state area, they've created a smart and cooperative reopening concept for economies in the Northeast region. But I just saw right before I got on the call that the non-essential shutdown has been extended to May 15th for the East Coast states. So now is really not the time to let up on the efforts that have been helping to flatten the curve to some extent. In terms of what does this mean for recessions, we hear all sorts of letters, L, U, V, W. I think we're going to have a very unique recession in the US. This has been somewhat of a self-inflicted recession. If you look at Q2 estimates for GDP in terms of the contraction, I've seen numbers ranging from -30% to close to -40% for the second quarter. And likely we would see a contraction in the third and potentially fourth quarter as well, with a strong recovery as we see a dramatic, hopefully in the future, drop in cases. In terms of employment, we have seen some staggering numbers on the unemployment side. There's been about 17 million lost jobs, and that number is expected to increase. The unemployment rate is expected to be in the 15 to 20% range. And I'm using these broad, large numbers because it's a bit undefinable and there's no comparable experience to relate to this period that we're now in. In terms of what has been done by the Fed, and what has been done by Congress. And I would say there's been a lot of efforts to help fill the gaps where the economy is being effectively shut down. The monetary and fiscal response has been very quick. So if you compare it to the Great Recession in 2008, it took many months to get some of the programs that we currently have now, and some of the programs we currently have now are much larger. So the Fed effectively has brought interest rates down to zero. There's unlimited bond buying for treasuries and mortgages, and the assistance has recently been expanded to municipals and corporates. So there's been a lot of bond buying by the Fed. And on the fiscal side, the CARES Act, the $2 trillion CARES Act that was passed, increase unemployment benefits and support businesses through this economic shutdown. The small business rescue loan program hit its about $349 billion limit today. So I would expect more from Congress soon. In terms of volatility, from February 19th to March 23rd, we saw a big spike in volatility to levels that we saw back in the financial crisis in 2008. Major dislocations within the fixed income market compounded that volatility. We have seen volatility decrease recently. The market has experienced somewhat of a rally over the past couple of weeks. Some people believe that rally is unfounded. Others believe we will not retest our lows from March 23rd. I think there is optimism, and people are looking out past a couple bad quarters that are expected to the expected recovery. The pandemic has called into play some themes that benefit from increased technology. As Jay mentioned, cloud computing has really enabled employees to work at home. And cybersecurity has been paramount on everyone's mind. And we've built some portfolios based on some of the themes that Jay has talked about, which I'll talk about later on the webinar. So with that, I will pass it back to Jay.
Thank you, John. Perfect. So obviously we're talking about thematic investing today, and as John was mentioning, the entire markets have changed because of COVID-19. Now there's a little bit of a tension in how we're going to talk about this, because as I mentioned before, thematic investing is best done over long time frames, multiple decades, as these technologies evolve and get adopted, or as these demographic changes happen. But at the same time, we have to recognize that the current landscape is changing things very quickly, very volatilely. So as we go through this presentation, I'm going to highlight both the long-term thesis for some of these themes, as well as what has changed recently and how that might impact the trajectory of that long-term structural shift. So starting very short-term, very myopic in nature, what has changed with thematic investing thus far year to date? Well, themes have gotten cheaper. One of the questions we often get from clients is, what are the valuations of these themes? If you're investing in something that's very high growth, of course, it can look very expensive on certain metrics. So we track this very closely. But one thing we do is we do have a preference for what metric we look at when we're trying to define how expensive is a theme. So we don't look at price to earnings. Earnings in itself is a little bit problematic because most of these companies are not trying to be profitable, at least not yet. They're still very early stage. They're investing heavily in technology, investing heavily in sales. They're not at that stage where they're trying to return capital to shareholders through dividends or buying back shares. They're trying to grow like heck, and that's where you're going to see very low earnings. So what we do want to look at is price to sales. Sales will show us how quickly that technology is being adopted by the market on that adoption curve. And secondly, with thematic investing, you're really buying into a growth strategy. And so it's not just a question of what is the price to sales, it's how much are you paying for that sales growth. So we use this metric, price to sales to growth, which is actually very similar to the PEG ratio, which is price to earnings to growth, but it's just replacing the E with the S. And you'll see that a lot of themes are kind of in that 0.2 to 0.4 range, but the vast majority of them are trading below where they were at the beginning of the year. Very simply, the markets have sold off. But in some cases, what's also happened is the G, the growth part of that equation, has actually increased for some of these themes. Think about an area like video games and esports. Hero over on the right, that's actually seen an increase in sales revenue. And we've seen some companies in the cloud computing space that have seen phenomenal growth over the last few weeks. So we want to consider all of those different items, not just the price, but their sales and their future expected growth. Themes are cheaper in this environment, and there could be some opportunities for bargain hunting. Next slide. So I do want to dive into two of the themes that we see as the most powerful in the world today, and these also happen to be two of the largest themes on that slide that we were showing before in terms of total assets under management across the US ETF industry. The first being robotics and AI. So as I mentioned before, we're going to start with the big picture, the structural case for the theme, and then kind of zero in on what's happening with COVID-19 and how that might be propelling the theme in the current environment. So robotics and AI, I'm sure you've read about it in the paper. It's a pretty well understood theme at this point. Robotics is the body of a machine being able to do actionable physical things in the world, such as picking up a piece of sheet metal, picking up a box, delivering something, all of those physical actions. Artificial intelligence is the mind. It's the brain, it's the computer that's telling the machine what to do. Both of those items, both of those components, we believe are actually one theme combined, just like the human body, the body and the mind work together. Of course, we can show these bar charts with, huge expected growth rates, but overall, we're seeing huge capabilities in the technology that's going into robotics and AI. We're seeing on the mechanical engineering side, robots that are more capable of things than ever before, more precise, more gentle, more dexterous. And on the artificial intelligence side, we're seeing the brains being smarter than ever before, being able to process more information faster, more accurately. All of that means that robotics and AI can be used in more capacities than ever before. The next slide. So these numbers are pre-COVID. This was just kind of the normal trajectory that we were seeing across the world. This, on the left-hand side, you're seeing the growth rate for industrial robots. So most robots didn't really grow last year. You had a little bit of a recession in two important industries for robotics, which is automobiles and cell phones, where robots are used very heavily. But the expectation was over the next few years that you would see pretty strong robotics growth as more industries try to mechanize or automate their production. How much potential is there for that automation? Well, on the right-hand side, it's this metric called robotic density, which shows the number of robots per 10,000 manufacturing workers. You can see at the very high end, Singapore and Korea are right around 800 workers, 800 robots per 10,000 workers, which is a penetration rate of about 8%. So 8% penetration is still very early. Remember, we were talking about social media at 84% penetration. So this is very early in the curve. But if you look around the world, it's really at about 1%, meaning there's so much more potential for robots to take on more and more work in industrial capacities. And this is just in the manufacturing space. This does not include autonomous vehicles. This does not include healthcare robotics and surgical robots. It doesn't include drones. This is purely in the industrial segment where it's still very early in the adoption curve. If you go to the next slide, this is the reason why robots are being adopted faster than ever before, and it's very simple. It's about cost. Labor costs tend to increase as productivity increases, as inflation increases. Technology costs tend to deflate as people get better at building those robots, as the components get easier, as the scale increases, prices go down, and that divergence is going to continue to get wider and wider. So purely from a cost perspective, that should be a key motivator for increased adoption of robotics. So what does COVID have to do with all of this? I think it's important to realize that over the last couple of decades, the key trend has been globalization, and within globalization, outsourcing labor to lower cost countries. Places like China were obviously a big beneficiary of that, as people could move jobs from the United States to China, paying workers significantly less to do a similar job. Even as China has gotten more expensive, you've seen those jobs then move to other countries with more inexpensive labor as well, like Vietnam or the Philippines or Bangladesh. It's been constantly moving around the world to find low-cost sources of labor. COVID really puts a bit of a question mark on that trend for a couple of reasons. And one is geographic concentration is now a real risk to supply chains. Think about when Wuhan was shut down entirely and most of China was shut down at the beginning of the COVID-19 outbreak. The impact in the US wasn't really felt from a consumer side yet. People were still going to work and buying things. The problem was on the supply chain. People were worried about whether they would be able to get shoes from Asia to be sold at Foot Locker. And people were worried if Apple could get their cell phones manufactured in time for their next rollout of a new phone. So that concentration geographically, given the outbreak, started to present real risks to US companies who depended on China for that output. But secondly, now there's real geopolitical risk as well, with the phase one trade deal maybe pushing some of that risk aside. We have certainly seen heightened trade tensions between the US and China, the US and our North America trade partners, our European trade partners. So suddenly this very connected globalist world presents a lot more risk in terms of that supply chain, whether it's due to geopolitics, whether it's due to disease. And what that means is a lot of companies are now going to start seriously looking at moving that manufacturing process back to the United States. But they're not going to do that and pay a lot for labor, 4 or 5 times the cost of labor. They're going to do that and they're going to use robots to keep those costs low. And it's because of that chart on the right-hand side where those robotics costs keep falling further and further. So we think COVID-19 is going to be a major accelerant for the robotics and artificial intelligence theme as developed markets use those robots to grow. Next slide. A question we often get about this theme is, are robots and artificial intelligence directly opposed to human working jobs? In some ways, yes. If you look at the chart we just showed, if you can save money using a robot, people will do that. However, I do think it's important to show that this is not, robots can't do everything. They're good at certain tasks, but humans are still very good at other tasks. This was illustrated for us very clearly when the Global X research team went to an Amazon fulfillment center about a month ago, back when we were allowed outside. And you could see this working really in kind of an amazing harmony where robots were used for specific tasks in that facility and humans were used for very specific tasks. So what are robots good at? Robots can move around a floor very efficiently. Think about, bookshelves in a library. Robots can move around those bookshelves very efficiently because they can read barcodes on the ground. They can bring over a bookshelf to a human if they have a certain product that they need to pick from that shelf. That's easy for a robot. What's harder for a robot is to then identify that object, pull it off of a shelf and put it into the right place. That's because items can be labeled slightly differently. They can be arranged in a slightly confusing way. Humans are very good at picking out an object from a pile and being able to put it somewhere else. Robots not quite so good at it. So that's why one of the roles in the Amazon factory is being a picker. Another area where robots are very good, they can do automatic labeling, they can do automatic scanning. That can be very efficient as well, but they're not very good at taking that object out of a box, reorienting it, packaging it, and then boxing it up. So that's another area where humans are working alongside the robots. So it's very interesting to see this in real life, but you have aspects of the industrial process that lend themselves very well to robotics, and there's aspects that are still very much in need of human input. I do think that line will continue to blur as robots get smarter and more capable than ever before. But what we're often seeing in these industrial settings is robots and humans, not robots or humans. Next slide. So the other theme I want to touch on today is cloud computing. As we mentioned, this is now the largest theme in assets in the US. There's a variety of different products in the space. What is cloud computing? It's really the combination of a few different areas in the market. The first one being software as a service. software that's delivered over the internet on a subscription basis. So think about if you use Salesforce, even if you use Netflix, if you use Workday, Zoom Video. A lot of these companies are some sort of software as a service that's being delivered to you. The other more common cloud computing company is infrastructure as a service. These would be companies like Amazon Web Services or Microsoft's Azure or Google's Cloud that are providing that computing power, that horsepower, and that memory storage that companies can subscribe to. They can rent that space, or they can rent that compute power so that they don't have to develop it on their own. If we go to the next slide, you can see why this is a really important development in the IT world. On the left-hand side is really what the world used to look like. You used to have law firms and hospitals and asset managers and you name it, any business had its own IT division, buying hardware, setting up desktop computers, setting up servers, installing the software on those computers. It was a lot of work. It was a lot of manpower. It was a lot of management. It was a lot of work. It was a lot of investment that had to go into keeping all of those processes working. You know, for a law firm or a hospital that does not have a core competency of anything in IT, they should be focused on legal expertise, on health expertise, on asset management, anything but the IT. The cloud has allowed people to outsource virtually all of that to other businesses. Now you don't have to upgrade your hardware as often. The new software is immediately pushed to you when you access it through the internet. So suddenly these huge IT teams that had to be developed on premises within companies now are completely pushed over to the experts who are incredible at developing software and updating hardware and whatnot. So you're seeing a lot of companies simply move over to the cloud because it's easier, it's more predictable, and it's less ongoing kind of maintenance and management from the company's side. Go to the next slide. So there's been a lot of growth in cloud computing over the last few years, maybe even a decade. And you can look at that growth both horizontally and vertically. So horizontally are what solutions have been built for specific parts of businesses, sales, coming from Salesforce, HR software coming from Workday. These are specific cloud computing or software as a service companies that are identifying a need within businesses and developing software to help that need, to address that need by developing efficient software, by storing data in the cloud that can be accessed by that software, et cetera. The other way of thinking about it is vertically integrated, which includes software as a service companies that are tackling specific industries to provide all-encompassing software to it. One of the biggest is our industry. Banking, securities, and insurance is a huge portion of vertical software as a service, as you see a lot of banking institutions and asset management institutions really digitize and outsource a lot of that technological capability. So whether you look at it horizontally or vertically, lots of growth in the cloud computing space. If we go to the next slide. Here's where we see a little bit more of the recent trend with COVID-19 and cloud computing. So the long-term structural trend, nothing really changes. The trend of companies looking to outsource more of their IT to software as a service and to rent that memory and storage and computing power is continuing. The difference is it used to be a little bit more of a thing that companies wanted to implement because they knew it made sense. Now it's something companies have to implement. Companies have to allow their workers to work from home. They have to be able to virtually pipe into their desktops at work. They have to be able to video conference. They need access to all the data that they would otherwise have at their fingertips in the office. So COVID-19 has really been a major accelerant for cloud computing because these processes that hadn't been switched over to the cloud yet now suddenly have to be switched over to the cloud. So we're seeing, massive surges over the last month or so in, work from home software, video conference, virtual campus, et cetera. But really, you've seen a lot of companies and maybe even your own really quickly try to implement some of these software as a service or cloud computing solutions as a requirement to be able to enable their employees to continue working from anywhere around the world. That used to just be kind of a nice to have feature. Now it's a must have feature for the world.
Well, thanks, Jay, for walking through both the cloud computing theme as well as the AI theme behind it. We're going to go a little bit deeper into how you can use these, both what we at CFRA think of some of these themes, as well as how Global X has built a portfolio of tools to be able to help advisors out. Before we move further into it, I would encourage folks to take advantage of the opportunity to ask questions of both myself as well as the colleagues from Global X. You can do that on the panel that's there, and we'll get to as many questions as time permits. Let's move here to the next slide if we can. I mentioned earlier, CFRA is rating individual ETFs from a combination of holdings level analysis as well as fund specific characteristics. And on the slide that you're seeing here is our view of BOTZ, which is Global X's Robotics and AI Thematic ETF. I would mention we also cover Global X's Cloud Computing ETF, CLOU, despite the fact that it just passed its first anniversary. It had a 1-year birthday, probably had one of those Zoom birthday parties that we're seeing take place around where people celebrate in a different format than normal. But BOTZ is a 4-star rated ETF from CFRA. You can see it's global in nature. The US, as well as Japan, Switzerland, the UK, and Finland are among its largest countries. It's got a wide array of different sectors, or 3 main ones: industrials, technology, and healthcare, as opposed to a sector-specific strategies you may be using from State Street and others. And you can see on the screen here some of the top holdings: NVIDIA, ABB, Intuitive Surgical are some of the names you're probably more familiar with. There's some other names you don't know. On the right-hand side is you'll just see how we're covering this from both a cost, reward, and risk perspective. I would highlight that a higher score that you're seeing for risk means it's relatively safe, whereas a cost score that's relatively low, or in the middle of the range, shows where it's about average versus some of its global market peers. With that, I want to bring John in as we move to the next slide. John has a long history of building portfolios outside of the asset management industry, and now is doing it for Global X. John, do you want to talk about how you're doing the Disruptors portfolios?
Thanks, Todd. And thanks, Jay, for going over all of those themes. When we decided to create a thematic portfolio at Global X, we obviously leveraged Jay and his team in their in-depth research. Now, when thinking about building a thematic disruptors portfolio, we didn't have COVID-19 in mind. But what is very interesting that this portfolio, owing to some of the diversification that it already has and its overweights in certain areas, like information technology, which the portfolio that I'll talk about in a moment has about a 43% allocation to technology, and then about an 18% exposure to healthcare, fits very nicely, fortunately or not, with what's going on right now. So the concept behind this portfolio was to have a portfolio that transcend typical sectors. So you look at the gig sectors and say, what's going to disrupt a particular sector? What's going to disrupt financials? Well, it's financial technology. What about industrials? Well, artificial intelligence and robotics. And so we took a bunch of these themes that span different regions and decided to create a portfolio. So the first step was identifying those disruptive themes, whether it be the cloud or healthcare, industrials, or connected devices and things like that. So on the next slide, it just shows again the purpose of the portfolio. I mean, this portfolio is really originally designed to be part of a larger portfolio. I view it to be part of a larger asset allocation model. Typically, this type of portfolio is higher growth, more momentum-oriented types of exposures. What's very interesting during this period we are now living through is that whether it be against its own benchmark or against the broad S&P 500, it's actually on an absolute basis, it's done a lot meaningfully better. And that's because we are experiencing some of the themes play out within the portfolio. Now, the way we build a portfolio, as mentioned, we look at the traditional gig sectors, try to find something that's disrupting that sector. A new form of energy would be lithium that powers electric vehicles or autonomous vehicles. And then what we do is we look at the underlying companies within the portfolio of a particular ETF, look for the forward sales growth numbers for that company, and tree it up to the ETF level, which I'll talk about in a moment. And then we have a max allocation of 15%. So if an ETF has a very high growth rate based on the underlying components, underlying companies within that ETF, we don't want it that super high growth rate on revenues to skew the portfolio in terms of weightings. So we cap it at 15%. So on the next slide, we show, Jay talked about the diffusion of innovation theory. What we're really trying to focus on here is the acceleration of revenue growth in the early adopters, early majority stage before you're seeing a leveling off of revenues in the late majority and in the laggard period. So that's where our major focus is, trying to identify those themes that capture that growth within that portion of the sharp increase in utilization. So on the next slide, we show the way that we look at the forward sales growth numbers. If we took them simply from consensus and we looked at one point in time, sometimes certain readings would be skewed. So what we did, we looked at them in three different categories. One area where we weight 50%, we take a simple 4-week average. Then we look for a trending in the forward sales growth numbers. So we look over an 8-week period, average that, and look over the 2-year period and average that. And then for stability components, we look at the inverse of the standard deviation of those weekly numbers. And essentially what we're doing is for that 20% bucket, we're weighting the most volatile ETF based on the underlying components lowest and the least volatile the highest as a part of the weighted average number for this forward sales growth number that we're coming up with. On the next slide, we show the actual portfolio. The portfolio includes robotics, cloud computing, components of healthcare, connected devices, technology. It really is a broad-based portfolio, although it does have a technology bend to it. In terms of regions, it spans the globe. It does have a higher weighting to the US, about 67%, but China, Japan, Switzerland, and New Zealand have decent-sized components within the portfolio. And the way, I mentioned it earlier, the way I see this portfolio fitting in with a broader asset allocation of stock, bonds, and cash or alts would be a component of your equity exposure. And what is very interesting of late is that many of the themes really have played out when we typically suggest a longer term horizon for this type of portfolio of greater than 5 years. But right now, I think it's very relevant. On the next. So, one other component I want to mention is that the way we construct portfolios at Global X, and it's a little bit different than how other ETF providers create ETF portfolios, is that we take an agnostic view of the market. We will include other ETFs besides the Global X suite within the portfolio. So we have 9 different portfolios in aggregate. Certain portfolios have a large amount of Global X ETFs. Others have a 20, 30, or 40% allocation. So what we do, and what we're doing for the thematic portfolios, we're looking at all possible themes that exist out in the market. And then we look at asset size. We look at diversification and specific exposures of that ETF. Is that ETF accomplishing what we want in the portfolio? Is it fulfilling that exposure that we're looking for? And also, certain platforms that we're on have portfolio implementation limits. So we want to make sure that if you are buying a smaller portfolio, you're still able to buy a share of the ETF that we're looking to target for a particular allocation. Obviously, we're looking at spreads and tradability as well. So again, a differentiator here is that we are agnostic. We are trying to find the best possible ETF that satisfies a particular allocation. So if you're looking at the where to find our portfolios, we're available on several different platforms. First of all, you can go to the Global X website and create an advisor login. And behind the login, you'll find monthly updates, fact sheets, performance reports, market summaries, methodology summaries for each portfolio, and the benchmarks that we use for each portfolio. And also, these portfolios are available on outside platforms, different portfolios on different platforms, whether it be on InvestNet, TD Model Marketplace, Interactive Advisors, Interactive Brokers. So with that, I'll pass it back to Todd.
Thanks, John, and thanks, Jay, for your earlier comments. If you have not submitted questions and you have some for myself or the Global X team, now is a great time to be able to do so. I want to take one that came in. Jay, you talked about a number of different themes on the price to sales slide earlier. E-commerce seems, in particular, I'm seeing deliveries to my building and particularly to my apartment increasing significantly. What are you seeing? And eBiz, EBIZ, I believe, is the Global X ETF.
Yeah, it's a great question, Todd. And e-commerce is an interesting theme because on one hand, it's been around for a while. I mean, I think most people on this call I'm sure everyone on this call has bought something online at some point. And yet, if you look at the big picture numbers, a little over 10% of total retail sales are happening online. So again, the penetration rate of something even as established as e-commerce is still relatively early. So there's a couple of things going on right now. One is, of course, with COVID-19, I think anyone who hadn't bought something online is suddenly learning how to. I know my own grandmother is learning how to buy on Costco.com to get deliveries. So there's maybe a last push into that final segment of laggards that are signing up and ordering online. But I think people have to get more comfortable with ordering different types of products online. So one of the reasons why we're only at around 10% penetration of retail sales being online is that two major categories haven't been really adopted from an e-commerce perspective. The first one being groceries, and the second one being vehicles. So in this current environment, I have to think that the grocery delivery is a business that has been very slow to shift to e-commerce, but would probably see a huge acceleration as people start looking to take those deliveries rather than going out to stores. So this could be a major accelerant for the e-commerce theme. Vehicles is kind of interesting because one, people aren't really buying cars right now, to be frank. But it's also something that people probably enjoy doing more in person than online. There's certain things that people are happy to buy online. I think people are happy to buy electronics online. They can browse, they can shop, they can compare specs, they can get it delivered to their house. You see a lot of people, a huge percentage of electronic sales happen online. But cars, people want to see them in person. They want to test drive them. They want to talk to the to the dealership. And how do you replace that with an online experience? How do you do that for groceries if you're shopping for fresh fruit that you want to look at yourself? How do you do that for jewelry that you want to try on? That is probably the next frontier for e-commerce with the introduction of augmented and virtual reality, where through digital experiences you could replicate what it means to drive a car, or through a digital avatar you could replicate what it looks like to try on a necklace or a bracelet and see what it would look like on you. So e-commerce is definitely benefiting in the short run from COVID, especially in that grocery segment. In the long run, though, I think it's going to be new technologies that help simulate some of that in-person experience that pushes it forward.
Thanks, Jay. So John, a question for you regarding the portfolios. Is there a scheduled rebalance that takes place for these portfolios, or given the volatility we've seen in the marketplace, is there flexibility?
Sure. I mean, we typically rebalance the portfolios on a quarterly basis. There's no set date that we actually make the rebalance. For the Thematic Disruptors portfolio, it's actually a quant model. It's a partial quant model. We select the ETF, then we run it through the model. And if the model says that we need to make an allocation change that's greater than 1%, we'll likely make that change. So it typically happens 4 times a year, but there's been cases where we actually didn't make a change because the changes were below that 1% mark. In terms of what's going on recently, we recently did make a change on the 24th, and that partially had to do with what's going on, but it sort of kind of ran into our quarterly change in any case. But again, it's not on a set or specific date.
Okay, great. Well, thanks a lot, guys. We'll move to the next slide here, which just tells you a little bit more about Global X and why Global X was the partner that made sense to talk about thematic investing, both from an ETF, research, and portfolios perspective. You'll see on the next slide about more from what CFRA is offering. One, if you're not using MarketScope Advisor, if you're not currently a client of CFRA's and are not familiar with all the tools we have, we'd encourage you to check out our website. You'll find out more about our ratings of the individual stocks behind these ETFs as well as the ETFs. We'd also encourage you, as you'll see on the left-hand side, to join us for our May webinar. Let's go back, if we can, for a moment to just let folks see the date and details about this, about seasonal investing. Sam Stovall, our Chief Investment Strategist, is going to join me and some colleagues from John Hancock to talk about sector investing and whether to rotate or retreat given the current environment. I believe you may have already gotten an email invitation about that webinar. Looking forward to talking to Sam about sector rotation. Lastly, on this slide here is just an invitation for you to share with your individual investor clients. Let's move to the next slide, please, where you'll see about the Outlook publication that we have talking about how we're serving independent investors, individual investors with our independent newsletter called The Outlook. Lots of great research and commentary. We at CFRA tend to serve the financial advisory community primarily, but we've gotten strong interest from individual investors, and we want to make our tools available for free to give folks a chance to stay up to date with the marketplace. With that, I want to move briefly to the last slide here to just thank you for joining in, thank Jay and John for walking through such great content, and appreciate all the interaction we've had with the audience. So thank you, and have a wonderful day, and stay healthy and stay sane. Have a great day.